So this video is about the bull spread using puts. So on another video we talked about the bull spread using calls, where our expectation was that the market was going to go up, and we wanted to take advantage of this by buying a naked call and then trying to make it cheaper by converting that naked call into a vertical spread by writing another call on top of it. So this time we still have an expectation that the market is going to go up. So I'm going to use the example of Apple again. And so let's say that we expect Apple to be $250 plus by next week. So this time, however, we are not trying to make it cheaper, and we are not buying a naked call. This time, this is we still expect the price to go up, but we're going to be using put options. And this is not to make it cheaper. So with the bull spread using calls, it was a speculative position. We expect the price to go up, and therefore we bought a naked call. To make it cheaper, we wrote a call to make it a vertical call, a vertical spread. With the bull spread using puts, we are going to do what's called a credit vertical spread, and we are doing this with the intent of generating an income. And this is the first time in this class that we're talking about generating an income with options. So let's take a look. Our expectation is that the price of Apple is going to go up. So what we're going to do, we are going to look for where it's not going to go, which means we are going to put an expectation for a bottom price. Let's say that current price is $247. Let's say that we expect price to go high, and on the bottom side, let's say $235, close enough. This is our $235 line, approximately. And we're basically saying that we don't think it's going to go below 237. We expect Apple to go up, and we do not think, or we do not believe, that it's going to go below 235. So what we're going to do is we are going to write a put option, and notice how risky this is. So strike price is 235. Maturity is April 3rd, and option price is, let's take a look, 235 put option. This is a 235 put option at $5.40. So $5.40 that we collect. However, this is a tremendous amount of risk. We are writing a naked put. We're collecting $540, yes, which is, we look at it as an income. However, if the price ends up at a lower value, then we can lose a lot. For instance, if Apple price were to go down to $200, then we lose $35 per share. At 100 shares, we lose $3,500. If Apple were to go down to $100, then we would lose $135 a share, or $13,500 in total. So we could lose tremendous amount of money. This is a naked put. So how do we, buy some protection? So what we can do then, what if we were to buy a put option and limit the amount of money that we could potentially lose on our naked put? So we basically are writing a naked put, and then we are buying an insurance to limit the amount of money that we could potentially lose. So we're going to buy a, I don't know, 215 So buy a put option at a strike price of $2.15. Maturity is the same, April the 3rd, and option price then is $196 that we pay. So overall cost or income, well, we're collecting $540 and we're paying $196. So $344 that we collect. So the idea is that we wrote a put option, $235, and then we bought ourselves an insurance at $215. Yeah, approximately. So don't forget, our expectation is that Apple is going to go up. So while it's going up, we're hoping that this naked put that we wrote, we will get away with it. Meaning we are going to collect our $540 and that option will be worthless by Friday's closing, and therefore we get to keep our $540. However, that is a risky strategy, as you know from the third week, that we could lose awful lot of money. Therefore, what we do is we buy ourselves a put option as an insurance. What if it were to go down to $100? Something really bad happens at Apple, and then the price goes down to $100. We don't want to lose $13,500. So what we do is we buy ourselves an insurance, a put option at $215, and then we pay for this insurance at $196, and therefore overall we collect $344. So what happens is, if Apple, as expected, continues to go up, then both of our options will be worthless by Friday's closing, and we get to keep our $344. If, however, Apple were to go down, well, at this point, all the way down to $235, it can, and we wouldn't care. However, if it starts to breach beneath $235, then we start losing money. We start losing money in between this range, and then there's a maximum amount of loss that we could incur, and then anything below 215, we will not lose more than our maximum loss. So what is our maximum loss? It is the difference of the strike prices. So 235 minus 215, it is 20. So we could actually lose $2,000. So we are getting $344 income by taking a risk of loss for $2,000. So let's take a look as on a spreadsheet. So we have a written put, and then we have a purchased put. So the strike prices are $235 and then $215. Now notice, so price on 4/3, let's say that the price is $300. Well, the written put will have no value, so we don't actually lose any money. And then on this one, again, we don't lose any money. So since the written put, we collected $540, and then this one we actually paid $196. So overall, we are actually collecting $344. We get to keep our $344. However, if the price on 4/3 is, say, $225, then on the written put, we actually lose 225 minus the 235, we lose $10. Now, with respect to the purchased put, because 225 is above that, we don't make or lose anything, and the purchase put dies worthless. So we collected 344, and then we have a loss of $10 a share, so $1,000. And overall, we have a loss of $656. Again, if on the price on 4/3 is, say, $150, well, in this case, we are going to lose on the written put a lot of money. That's $8,500. However, in this case, because we purchased the put, now we get to make money. So $215, and then the current price is $150. Whoops, sorry. This is $150. So $215 because we purchased this, and then we make $65. So again, we collected 344, and our loss is 85, and then, right, we have 100 shares, so times 100 times 100, so we lose $2,000. So all in all, then it is 2,000. We lose $1,656. If the price on April the 3rd is, say, $100, well, it's the same. 100 minus, because we are writing this, we have a loss of $135. And then on the purchased one, because we purchased this, it actually makes us money. Don't forget, this works like an insurance. Now notice, again, we collected 344, and then our loss is this one plus that times 100, again, $2,000. So overall, the loss is $1,656. Notice, however low it goes, our written put is losing more and more. However, our purchase put is acting like an insurance. Anything below that 215. And as it continues to go down, we would not lose more than 1656. However, if it goes up like we expected, then the $344 that we collected, we get to keep. So basically what we're betting on is that the price is going to go up. We collected 344 for a potential loss of 1656. Now, the idea is that this is a bull spread, meaning that we have an expectation that it's going to go up, but we are using puts. So this is referred to as a credit vertical spread, or a credit spread with puts. And the expectation is either Apple is going to stay the same, or Apple is going to go up, or better yet, Apple is not going to go down. If Apple does not go down, then we get to keep our $344. If Apple stays the same or go up, we get to keep our $344. If Apple goes all the way down to $235, we're still fine. But anything below $235, we start to lose. And then if it goes below our insurance, the maximum we'll lose would be $2,000 plus what we collected initially, and therefore a total of $1,656. So this is an example of a credit vertical spread with puts. It is credit because we are collecting 344 at the beginning when we set this up. So the difference then between the bull spread using calls and the bull spread using puts. The bull spread using calls was we buy a naked call and then we write a call to make it cheaper. We're still betting it's going to go up, and we're paying money for this expectation. And by making this a vertical spread with calls, we're just making it cheaper. But we're still paying money to bet on our expectation. With the bull spread using puts, well, this is intended to generate an income based on our expectation. We are expecting that the price is going to go up or to stay the same, or at least it's not going to go down. And we are writing a naked put to take somebody else's money. And then we're buying ourselves an insurance with puts again, just in case we are wrong. And we are limiting the amount of loss we could incur if we are wrong. So this is an example of a bull spread using puts, or a credit vertical spread with puts. Let me know if you have any questions. Thank you.